Most people approach investing as a series of separate decisions. They see a stock going up and they buy it. They hear about real estate and they try that next. Then maybe crypto, then something else. From the outside, this feels like progress, but in reality, it's just financial randomness. Professional investors operate very differently. They don't start with investments. They start with a structure, a system that determines how money enters their life, where it goes, and how it grows over time. Without a financial system, every investment becomes an isolated guess. You might make a good decision once, maybe twice, but over time, random decisions eventually cancel each other out. And this is exactly why many people spend years investing without actually building wealth. The missing piece isn't effort, and it isn't intelligence, it's structure. Because when your financial decisions follow a framework, every new investment becomes part of something larger. In the previous video, we talked about why working harder alone doesn't necessarily lead to wealth. Many people believe that if they simply work more hours and earn more money, financial success will eventually follow. But as we discussed, income by itself doesn't automatically create long-term wealth. What actually matters is what happens to money after you earn it. And this is where professional investors think differently. Instead of relying only on effort, they rely on a financial framework, a system that guides how money enters their life, where it goes, and how it grows over time. Most long-term investors organize this framework into 3 layers: capital generation, capital allocation, and capital protection. Each layer has a different job. Generation creates new money. Allocation decides where that money should go, and protection makes sure the system survives unexpected risks. If one of these layers is missing, the entire structure becomes unstable. But when all 3 layers work together, wealth begins to grow much more consistently. Let's start with the first layer, capital generation. This is the engine of your financial system. It determines how money enters your life in the first place. For many people, that engine is a single source of income, their salary. But investors usually try to build more than one engine, because relying on only one source of income creates fragility. And fragility is the opposite of financial stability. Strong financial systems often include multiple sources of income: a primary career, dividends from investments, rental income from property, ownership in businesses, or even royalties and digital products. The purpose isn't just earning more money. The purpose is building income streams that can grow independently of your time. Because when income becomes scalable, your financial system begins gaining momentum. And momentum changes everything. When your income grows faster than your expenses, you create financial surplus. That surplus becomes the fuel for the second layer of the system, capital allocation. This is where most wealth is actually built, because earning money is important. But where you place that money over time is what determines your long-term financial trajectory. Capital allocation simply means deciding where your money should go after you earn it. Instead of spending everything, investors redirect a portion of their income into assets. Assets that can grow, assets that can produce income, and assets that can appreciate over time. This process transforms active income into long-term wealth. But successful allocation requires discipline, and it also requires diversification. Diversification means spreading your capital across different types of investments, instead of relying on a single opportunity. For example, many portfolios combine stocks, real estate, and sometimes private investments. Each asset class behaves differently. Some grow faster, some produce income, some protect value during economic uncertainty, and together they create a more balanced financial structure. Before making an investment decision, experienced investors usually ask three questions. First, what is the potential return? Second, what is the downside risk? And third, how does this investment fit into my overall system? This last question is often the most important, because even a good investment can become a bad decision if it disrupts the balance of your portfolio. The third layer of the framework is capital protection, and surprisingly, this is the layer many beginners ignore. But professional investors think about risk constantly, because markets change, economic cycles shift, and unexpected events always happen eventually. Protection ensures that a single mistake doesn't destroy the entire system you've built. There are many tools investors use to protect capital: diversification across assets, maintaining liquidity, keeping emergency reserves, and avoiding excessive leverage. These ideas may sound conservative, but long-term investors understand something important. You cannot compound wealth if you repeatedly lose large portions of your capital. When these three layers begin working together, something powerful happens. Your finances stop behaving like random events. Instead, they begin functioning like a system. Income flows into investments. Investments generate new capital. Protection stabilizes the structure, and every part of the system reinforces the others. Over time, this structure produces one of the most powerful forces in finance: compounding. Compounding happens when your investments begin generating returns, and those returns are reinvested back into the system. Year after year, the process accelerates. At first, the growth looks slow, but over long periods, compounding can transform relatively modest investments into substantial wealth. This is why experienced investors think differently about time. Short-term market movements rarely matter. What matters is whether the system continues working over decades, because wealth is rarely created by one brilliant investment. It's usually created by a well-designed system that keeps operating year after year. If you want to build long-term wealth, stop focusing only on individual opportunities. Instead, start designing your financial system. Build strong income engines, allocate capital intelligently, and protect what you've already created. Because when your finances operate as a system, growth becomes far more predictable. And in the next video, we'll explore the major asset classes investors use to build diversified portfolios.